Oil is rising, airlines are under pressure, defense stocks are heating up, and in the middle of a geopolitical shock, AI stocks are still flying. The Iran war is no longer just a military crisis. It has become a market event, reshaping winners and losers across global sectors. The first and most obvious winner is energy. Whenever conflict threatens the Middle East, oil markets react almost instantly. Traders fear supply disruption, shipping risks, and possible pressure around key routes like the Strait of Hormuz. That fear pushes crude prices higher. Reports have already shown oil jumping sharply during recent Iran-linked escalations, with Brent crude moving higher as investors priced in supply risks. For oil producers, this can mean stronger margins. Energy companies, especially those less exposed to damaged or risky infrastructure, often benefit when crude prices climb. But there is a catch. If the conflict eases or a ceasefire looks likely, those gains can quickly reverse. Reuters reported that energy stocks fell sharply after hopes of a US-Iran ceasefire dragged oil prices lower. The biggest loser is aviation. Airlines are hit from two sides. First, jet fuel becomes more expensive. Second, airspace disruptions force longer routes, delays, and cancellations. During Middle East tensions, several airlines have had to reroute flights, avoid conflict zones, and absorb higher operating costs. This directly hurts profitability. When oil rises, airline stocks often stumble. When oil falls, they recover. That shows how sensitive the sector is to fuel prices. AP reported that US airline shares gained when oil prices eased, underlining how quickly sentiment changes in this sector. The second major winner is defense. Wars create uncertainty, and uncertainty increases demand for military spending. Investors usually move toward defense companies when governments are expected to order more weapons, surveillance systems, drones, missiles, and cybersecurity tools. In a conflict involving Iran, drones, air defense systems, and precision weapons become central to the market story. This is why defense stocks often rise during prolonged conflict, especially when the war signals a longer period of military procurement. Then comes technology, especially AI. This is the surprising part. Normally, war and high oil prices create fear in markets, but AI stocks have been strong enough to offset some of that fear. The Financial Times reported that since the outbreak of the Iran war, major companies added trillions of dollars in market value, largely driven by the AI boom. Chip makers and semiconductor-linked firms were among the biggest beneficiaries. Why is AI still rising during a war? Because investors see artificial intelligence as a long-term growth engine. Even when geopolitics is unstable, money keeps flowing into companies linked to chips, cloud computing, data centers, and AI infrastructure. But there is risk here too. If energy prices stay high, data centers become more expensive to run. If supply chains are disrupted, semiconductor production can face pressure. So AI may be a winner for now, but it is not immune. The biggest pressure point is consumer-facing sectors. When oil rises, transport becomes costlier. Goods become more expensive. Inflation fears return. That hurts retailers, consumer goods companies, automakers, luxury brands, and travel platforms. Consumers cut back when prices rise and companies face higher input costs. Markets are also watching inflation and interest rates. If oil keeps climbing, central banks may find it harder to cut rates. That can hurt borrowing, investment, and consumer demand. So the market map is becoming clear. Energy gains when oil spikes. Defense gains when war risk rises. AI gains because investors are betting on future growth. But airlines lose because fuel costs rise. Consumers lose because inflation returns. Travel and retail lose because spending becomes cautious.
If you like this video, then like, share and subscribe to Mirror Now.